So team, Google tells us everything, doesn't it? Google tells us that some of the most frequently named search terms or frequently used search terms in all of the internet right now have to do with housing market meltdown, inflation, recession, and mortgage rates. So since that's what people on Google are asking, I'm guessing that is streaming through the consciousness of all humans in the United States. And so that's really going to be the focus of what we talk about tonight. And the idea is, are we headed for a similar meltdown as we saw in the housing market to the Great Recession? So we're going to do a lot of comparisons to the Great Recession, show you a lot of data, and hopefully take you from, conjecture to actual confidence in making that assessment for yourself. Now, for those of you who don't know me, my name is Josh Mettle. I'm one of the co-creators of Neo Home Loans. I'm also a fourth generation real estate investor. As I mentioned, I'm coming to you live tonight from Park City, Utah, and my family, all from Utah. And my kids are now fifth generation real estate investors. So when I put together a presentation like this, it's not for theory or hypothetical. I am literally trying to figure out where is the market going and how should I be dealing with my investments. And I'll tell you right now, I have 2 residential homes in Utah under contract. And the majority of this research that I did was in the exploration process of deciding if it was the right time to enter back into the housing market. So I'm going to share with you all that data and due diligence that I did for that. Let's start off. I want to interact with you, and I want to start off with a little bit of a survey. So be watching for that. It's going to come up here in just a moment. All right, here's our topic for the night. We're going to create a 2023 forecast for inflation, interest rates, the housing market, and we're going to talk a lot about a potential upcoming economic recession. This survey just came out from NerdWallet. It came out in January of this year, and I found it very interesting. It said that 67% of the people who filled out the survey expect an imminent housing crash. 61% told pollsters that mortgage rates are unprecedented, and 57% feel worse about their ability to buy a home in 2023 because mortgage rates are going to be higher in 2023 than they were in 2022. So if you are not a mortgage advisor and you are not a real estate professional, because I think you might have some insider knowledge here, but if you're outside of that group, help me with this poll if you would. Just go ahead and you should have a pop-up on your screen that says 2023 Housing Market Poll 1. And question number 1 I have for you is, do you believe a housing crash is imminent? Question number 2 on the poll, do you believe that current mortgage rates are unprecedented, meaning they've never been higher before? And question number 3, do you feel worse about your ability to buy a home in 2023 because mortgage rates will be higher? I'm going to give you just a minute to fill that out. Please give me your thoughts, your comments. I am very interested to hear what you think. And I'll give you just a second more, and we will kind of close out the poll here once we kind of see the results stopping to come in here. All right. The poll number 1 is closed. Wow, only 6% thought a housing crash was imminent. 94% thought it was not. All right, very good. Do you believe that current mortgage rates are unprecedented? 100% said no. And then, do you feel worse about your ability to buy a home in 2023? I didn't see a result for that. So, I have to scroll down. This is my first time using a poll, so we're all learning tonight, team. Let's see. 16% said, 44% said yes, they feel worse about their ability to buy a home in 2023 because they think mortgage rates will be higher. 56% no. Great. Thanks for your participation. We're going to ask a similar poll towards the end And I think you're going to find the contrast in those answers of the poll very, very interesting. Here's the other thing that I found really interesting about this NerdWallet survey. 83% said that buying a home is a priority to them. That was interesting for me. And 11% plan to buy a home in 2023. That would be 28 million Americans that plan to buy a home in 2023, which is interesting because there were only 5.95 million existing homes sold in 2022. So it just tells me there's a lot of demand out there, but it's unlikely all 28 million of Americans are going to find homes. And then 70% planned to buy a home in 2022, but failed due to offers that were not accepted or they couldn't find affordable homes. So what does this tell me? This tells me that there are a lot of people out there that are interested in buying a home. They maybe tried to buy a home in 2022. They got frustrated because of a lack of inventory and high interest rates and a lack of affordability. And if we can get some of those things to come in line, a little more inventory, a little lower interest rates, a little higher affordability, there is a massive pool, 28 million Americans that have interest in buying a home in 2023. All right. So let's dig right in. Why are so many people sitting on the sidelines? Well, we've had ourselves a little bit of a crisis of information. And these are headlines coming from the lead real estate correspondent for CNBC going back to 2015. And this is Diana Olick's research. And she said, going back to 2015, the housing market's in a bubble. We're going to crash. The housing industry doesn't create wealth. And what we did is we went back on each year that these quotes, we showed how much the average appreciation was for residential homes in each one of those years. We showed how many dollars in equity the average homeowner gained during those years. And we showed the average home price across America slowly ticking up with this appreciation. And the point of this slide is, there's always going to be somebody trying to seize the space between our ears, our brain. They're trying to get our attention by selling fear into the marketplace. And if a first-time home buyer or somebody that was thinking about buying a home would have delayed home ownership for 7 years, they would have lost $222,000 of potential equity. I mean, Diana has effectively called 13 of the last 0 housing recessions. And, reporters have just figured out that fear around the housing market really sells, although obviously the consequences for those who took action based on that have lost a lot of money. So I want to dive into the facts. I want to educate you on where housing affordability is likely to go. And I want to start thinking about how many of those 28 million Americans that are waiting in the wings to potentially buy a home in 2023, how affordable is that housing market going to be for them? And the first thing we should jump into is we should explain what are mortgage rates based on? A lot of people have the misconception that mortgage rates are pushed up or down by the Federal Reserve, by the Fed funds rate. And that's just simply not true. The Federal Reserve sets the Fed funds rate, which is an overnight 24-hour interbank lending rate. That's the rate of interest that banks lend to each other. Now, the Fed fund rate does impact directly home equity lines, credit cards, other variable lines of credit for businesses, but it doesn't have a direct impact on mortgage rates, although sometimes the direction that the Fed funds rate and mortgage rates are correlated. But what's the causation for mortgage rates to go up or down is actually inflation. So what you'll see here is the blue line, which is a 30-year fixed mortgage rate starting back in January of 2018. And below that is your core consumer price index, or CPI. Don't get lost in the technical jargon. It's a measure of inflation that the Federal Reserve looks at, and it's kind of like the gold standard or benchmark. So here's what we see. We see that inflation started out in 2018 below 2%. it went up to about 2.5%, and mortgage rates jumped from roughly 4 to 5%. Then inflation started to go lower from 2.5% back down to about 2%, and mortgage rates went from 5% down to about 3.75%. Then we had a little bit of a pickup in inflation, a little bit of a pickup in mortgage rates. Right here, this is the COVID recession. Any gray bar that you see throughout the presentation is going to indicate an economic recession. That's when the economy is slowing. And yeah, Joe, I do agree with you. There's probably likely a lot of young respondents that answered the NerdWallet. I believe that is the accurate demographic. And remember, the average first-time homebuyer, Joseph, is 33 years old. So that's probably exactly the demographics that are on NerdWallet filling out that survey. Thanks for your comment. So we would expect during a period of recession that there's less dollars flowing around the economy. Things are slowing down. So inflation drops, so does mortgage rates. And then this is interesting. Right here, April of 2021, inflation explodes. This pink line goes crazy. Inflation goes from less than 2%, 3%, 4%, 5%, 6%. But what happened to mortgage rates? How come mortgage rates didn't follow inflation? Well, you see these brackets here, the white brackets. This is a period of quantitative easing. This is when the Federal Reserve pumped out roughly $6 trillion in QE or quantitative easing. And they used that money to buy mortgage-backed securities. They used that money to buy treasury bonds. And that basically forced long-term interest rates down. Since they don't have a direct mechanism like moving the Fed funds rate, which is an overnight lending rate, they don't have a direct mechanism to impact mortgage rates. They became an artificial buyer. They rigged the game. They forced those interest rates to stay low. And the minute that quantitative easing ended, boom, mortgage rates take off from 3%, 4%, 5%, 6%. They peaked in November at about 7%, but here's what we want to pay attention to, team. Inflation peaked in the summer of 2022, depending on if you're looking at the core CPI or the non-core CPI or the PPE. You know, there's different measures of inflation, but they all pretty much peaked in the third quarter of 2022. And as inflation went down, which is now, as of yesterday, reported down from 6.6% in the core to 5.6%, so did mortgages. Inflation went down about 1%, mortgages went down about 1%. So if we want to know where mortgage rates are going, we don't watch what the Federal Reserve is doing, we watch inflation. And why do we think that inflation is going to continue to go down? Well, first, what we have to do is we have to dissect, how do we come up with the number that the year-over-year inflation is 5.6%. We got to get a little granular. We got to do a little bit of math. My fifth grade math teacher would be super proud of me right now. Hope he's watching. But we need to figure out, is the majority of the inflation behind us or in front of us? So let's look at the last 12 months, because if we want to know an annual inflation number, we have to add up the monthly inflation prints for the last 12 months. And if we do that, we would take the January 2023 back through the February 2022, and these gray boxes are the monthly inflation prints, meaning that this month inflation was up 0.5%, this month inflation was up 0.3%. You add those all together for 12 months, and you come up with a 5.6% year over year, give or take a little bit for rounding. But here is what is so important. You can see that these were the previous inflation prints that fell off, 0.6, 0.5, 0.6, and 0.5. Those were replaced with 0.4, 0.3, 0.2, and 0.3. So even though we're still seeing month over month inflation, it's at a much lower level than we saw a year ago. So the pace of inflation is slowing. And here's the deal. We're going to see a massive improvement in mortgage interest rates once we get rid of the April, May, and June inflation print. because in 2022, we were seeing 0.6, 0.6, and 0.7% monthly increases to the rate of inflation. And as we get the April 23, May 23, June 23 inflation prints, these will no longer be in the headline number. And if we keep in this lower range down here, we're going to see a drastic reduction in inflation. And that's going to be a signal to the mortgage-backed security or bond market. Inflation is behind us. We want to buy bonds now because the yield or the interest rate on bonds that they would earn as an investor is going to go down. So I believe that based on all of the data, we will see massive improvements in mortgage rates in April, May, and June of this year. Now, there's a few other reasons why I believe this, and I'll take you through some other data points. We do need to understand what the Federal Reserve is doing with their Fed tightening, why they're doing it, and what's the likely outcome on the economy. All these things play into the inflation picture and understand what's going to happen in the housing market. So the Fed rate hikes are happening at the fastest pace ever in the United States since the Federal Reserve was founded. And you can see through different cycles, like let's just take this gray one, for example, right? We move from, I don't know, this is probably about 0.25% in the Fed funds rate up to 2.25%. So we moved up over 2% in the Fed funds rate during this hiking cycle. But this was over a 36-month period of time. So over 3 years, they raised the Fed funds rate 2%. Well, in this cycle, they've raised from 0 to 5.25 now. And that happened in a period of about 10 months. So the Federal Reserve is using higher overnight lending rates, which increase credit card rates, increases the cost of businesses that borrow, increase the amount of the interest rate on your equity lines. My wife just told me that our equity line rate is 8.5%. I'm like, oh my gosh, pay it off, right? Don't borrow from that thing. It's way too expensive. And that's happening throughout the entire economy. And that's how they slow down the economy and try to counteract the inflation. So what is it working? What's happening? How is the federal funds, the Fed's action of raising short-term interest rates, how is it impacting the American consumer? Well, we've got a couple graphs here to show that we'll see that credit card usage, this is billions of dollars of balance of credit cards. And we can see from 2018, those balances went from about 760,000 to 860 billion, not thousand, excuse me, 760 billion to 860 billion. Then we had COVID recession. Everybody got locked in their house. All their paychecks went in their bank. They paid off all their credit cards because they couldn't go to dinner and they couldn't go to Hawaii. And we saw this massive drawdown in credit card balances down to 740 billion. But look what's happened since the stimulus checks ended and we became able to go out and spend money again. Well, credit card balances over $920 billion. So this is somewhere about maxing out the American consumer. And you can see at some point, right, that there's only, and not to mention, this is a record high credit card debt. And the average credit card interest rate is greater than 19% right now. So this is taking a major chunk out of Americans' budgets. Meanwhile, we see that during COVID, the savings rate, this is the amount of, this is the percentage of income that the average consumer saves versus spends. And we hit an all-time high of just over 34% of income was saved while people were locked at home. Then that number went down. We see the different stimulus checks, stimulus check number 1, stimulus check number 2, people saved the money. And since then, they've spent the money. So what type of picture does this paint for the average consumer? Let's throw this. Roger said, didn't they go way above 3% in 1983? Are you talking about the Fed funds rate, Roger? Let's see here. You're probably talking about, well, that's the Fed funds rate during that rate hike cycle. And I have a graph here in a few minutes that's going to show you what happened to mortgage rates. And yes, mortgage rates went way above that. I'll show you that here in a minute. So let's answer this in the chat if we could. What would happen to your home and your spending if your savings were depleted and your credit card balances were maxed out and you had financed those credit cards north of 19%? What would happen? Would you be spending more or would you be spending less in your household? If you'll throw some answers in the chat, I'd love some feedback and connection with you all tonight. Stop shopping. The graph was how much? Oh, hey, Ben, thank you. Yes, that's right, Ben. The graph on the Fed funds rate was the amount that the interest rate increased, not the rate of the Fed funds rate. Exactly. Thank you for that, Ben. Much less, probably zero, mac and cheese for dinner every night. Yeah, exactly. So when we have no savings and our credit cards are maxed out and we're at 19%, you're going to spend less. And so if we, for millions of households across the country, spending less, are we more likely to see a recession or are we more likely to see an economic boom in 2023? And I'm going to talk a lot about recessions tonight because there is a direct correlation to economic contraction, i.e. recessions, and deflation. And when you have deflation, you're going to see mortgage rates go down, and that's going to create greater affordability, and that's going to bring some of those 28 million potential first-time home buyers off the sidelines and into the housing market. So we're gonna vacillate back and forth on those different indicators. So I do believe that we are headed towards a recession. I'm going to show you some of the indicators. My wife would be really mad. I hear you. I hear you. So this is one of those. This is one of those recession indicators that is 100% accurate. Going back to 1960, it's never been wrong. And it's called the Leading Economic Indicator Index. And the cool thing about this index is it's an index. It's not just one indicator. It's 10 indicators put together. And when all 10 of those indicators are in a slowdown, are showing that their contraction was the word I was struggling to find. When all 10 of those indicators are in contraction, 100% of the time, you see a recession. So you can see when this kind of peaks and starts to go down, recession, we see a peak and the LEI goes down, recession, peak 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 recession, peak recession. Interestingly enough, it even projected the COVID recession, but it did peak and started to move lower before the COVID recession hit here in 20. And then you can see clearly this peaked and has moved lower. And I believe that we will see a recession here in the near future. And just to give you an idea, what are these 10 indicators? It's GDP, or the gross domestic product, the total amounts of goods and services created in the country. It's employment, it's industrial production, it's consumer spending, it's inflation, whether it's going up or down, it's home sales, home building, construction spending, which would include commercial construction spending, manufacturing demand, and retail sales. It's basically all of the major sectors of the entire US economy put into one index, and it is undefeated. When it peaks and goes lower, we enter a recession. The other reason why I believe that we're likely headed for a recession is called the inverted yield curve. Don't hang up and leave the Zoom, because I know that is a confusing phrase, but it's really super simple to understand. So let me explain it to you really quickly. We know that if we go to our bank and we want to borrow money, let's say against a car, and let's say we want the payment really low. So we want a 7-year loan on the car, which I don't recommend, by the way. But if you did that, you know that you're going to get a higher rate from the bank than if you went to the bank and said, you know, I'm going to pay this off in 12 months. So you can give me higher payments. I can handle it. I only need the money for 12 months. Well, the 7-year loan is going to have a higher interest rate attached to it than a 1-year loan. It's kind of common sense. That's the time value of money. The longer you want to borrow my money, the more opportunity cost I may lose. So I need to charge you a higher rate to make up for that. Well, there's this weird economic condition called an inverted yield curve. And that's when the yield or the rate that would be paid to an investor. So now go away from a borrower and pretend you're an investor buying a bond or a mortgage or something. And the inverted yield curve is where the yield or interest on a 3-month or 2-month maturity is higher than the yield on a 10-year maturity or a longer dated maturing bond. And there's a lot of reasons behind why that economic condition would exist. I won't get into it because it's a 30-minute dissertation. I need a whiteboard. But here's what I want you to know. When this economic condition exists, it has a 100% success rate of predicting a recession. So you can see going back to the 80s, we didn't even get into an inverted yield curve. So how they calculate this, they take the 10-year US Treasury yield and you minus the 3-month. And if the 3-month number is bigger than the 10-year number, it's a negative number. It's an inverted yield curve. So you can see it almost got to 0 in the 80s, recession, broke below 0. So that's an inverted yield curve, recession, below 0, inverted yield curve, recession, inverted yield curve, recession, inverted yield curve right before COVID, recession, and we are very deeply inverted. In summary, what this is this is the global elite, the hedge funds, the venture capitals, the wealthy families across the world saying, I want to tie my money up in a 10-year bond right now because I think interest rates are going to go down. And if I have to reinvest that money in 12 months, it's likely going to be at a lower yield or a lower rate that it'll pay me. So this is the money in the big money in the bond market all across the world saying interest rates are going down. There's a recession coming. The economy is going to contract. Now, why do I keep talking about recessions? Why do I keep talking about recessions? Well, they have a unanimous impact on mortgage interest rates, meaning it's always the same. If we go to the 2020 COVID recession, mortgage rates, just to be specific here, this is mortgage rates, went from 3.75 to 2.75. In 2008, the Great Recession, mortgage rates went from 6 down to 4.875. In 2001, 2002, rates went from 7.37 to 6.75. If we go to 1990, they went from 11 to 8.75. In 82, back to the previous point, yes, interest rates were a lot higher at that time. Rates went from 18% to 3%. We go back to 80, rates went from 16% to 11.75. So this tells us that recessions by definition are deflationary. If we have deflation, we're going to have lower mortgage rates, and lower mortgage rates are actually good for the housing market. And this is something that a lot of people have a hard time wrapping their head around because we all have recency bias. We're anchored into a significant event that happened recently. And if we go back to 1960, housing prices through this recession were pretty much flat. In 70, we saw housing prices go up through this recession. Same in 75, slight uptick. 80 and 82, uptick in housing values. These are national home values based on the S&P Case-Shiller National Home Price Index. 1990, home prices went up. 2002, home prices went up. 2008, home prices went down. But this was a very different environment that I'll show you here in the next slide or two. And then in 20, home prices went up. So again, what drives demand for housing by and large is demographics of first-time home buyers that bring new buyers into the market and housing affordability. Recessions, although there is some job losses, the people who haven't lost their jobs now have a much more affordable housing market to buy into. And as long as you don't have too much supply, that does very well for housing values. So let's start to contrast and compare 2006, 2008 to 2022, 2023, because I want to know, I got 2 houses under escrow. I don't want to buy into this. This was scary. I owned homes during this time. It sucked. It was painful. I want to make sure we're not going into that period again with the 2 houses that I have under contract. So let's compare. In 2006, 2008, the teal line here is the existing homes available for sale across the entire United States. And you can see that this number peaked out at about 3.8 million. There were actually more homes for sale, but this is existing homes and doesn't include new home construction. So there was a builder inventory on top of this. But it shows the point that we got to an all-time historical high of housing inventory. Now, the orange line is the vacancy rate. So this is how many houses out there are. I'm with you, Dan. I'm still trying to emotionally recover from 2006. Although if you held on to your house, you're probably pretty happy. But unfortunately, a lot of people weren't able to do that. And a lot of people are scarred. A lot of first home buyers are scarred because they saw their parents lose homes. They saw their parents lose their jobs. They saw their parents go through divorces because of all of the economic uncertainty. Like that was a very traumatic time for millennials, as well as their parents. So we see that in 2006, 2008, we had about 4 million homes for sale, which is the left axis. And we saw vacancy rates start to peak up, right? So we saw vacancy rates, higher vacancy rates, and more homes for sale. And if we follow that trend forward, we see that as of today, the last number I saw out of the National Association of Realtors showed there was about 970 existing homes. This excludes new construction, homes for sale, 970 million across the entire United States. Now there's 330 million Americans in the US. So only having 970,000 homes for sale, this is definitely an undersupply of home. But what's interesting is the National Association of Realtors doesn't bifurcate or separate out how many of those homes were under contract. And about a third of those homes were under contract. So there's really only about 600,000 homes on the market right now for sale because the rest of them already have accepted offers to be sold. So if we're comparing 2023 to 2006 and 2008, vacancy rates are very low. Housing inventory is very low. And that is a very different picture than we saw leading into the Great Recession, which is the outlier as it relates to home values during that period of time. Here's the other thing to keep in mind of demographics. How many new home buyers are entering the housing market as compared to the number of homes that have been built? So let's go back and look at some history. The blue bars or blue lines in the graph is household growth. What's household growth? How do households grow? Well, I have 2 kids. Xander's 13, Aria is 11. And when those kids get to 18 in one day, I get to kick them out or ask them to leave or sponsor them to leave. And they get to farm 2 more households. So our 1 household will become 3 households when those kiddos move out. And I say that jokingly, I love my kids, but I am excited for them to go to college. So we can see if we look at the household formations going back to 2002, home builders, which is gauged here by the annual housing completions, home builders were building about 1.6 million new homes in 2002. And there were only about 1 million, this is 1,000, so it's 1 million, household formations. So more houses than household formations, more houses than household formations, more houses, whoops, way more houses. Home builders built 2 million homes. And what in the world happened to our population? Household formations dropped to under 1 million. What happened in 2006, right at the housing crash? Well, in 2006, remember the average home buyer is 33 years old. So if we minus 33 from 2006, you go back to the year that Roe versus Wade was passed and abortions became legal 33 years before the demographic crash of 2006. Now, the other thing that was happening right about this time, 33 years ago, right? The contraceptives were really kind of getting normalized during that period of time. So because of the change in contraceptives and abortion, we saw a drastic reduction in the birth rate. And then 33 years later, household formations dropped like a rock. Look at this, below 1 million, 500,000, 500,000. And we've got way too much home builder activity. And this ship doesn't really get fixed until 2015. But look what happens in 2015. Household formations up over 1 million, new construction below 1 million. 2016, back to that relationship. Home builders are building more than the household formations. But since 2016, we've clocked 6 straight years where we have seen the number of household formations be above 1.5 million, and the number of new built homes are drastically lower than household formations. So basically, we had way too much building and not enough household formations leading into the Great Recession and housing meltdown. And we've had exactly the opposite of that going back, I guess you could say back to 2015, so 6 or 7 years. So this is a very different housing market, as is evidenced by the amount of supply of home nationwide. And this is all supply and demand, and it's all demographics. The other thing that's different about 2023 than 2006 to 2008 is the type of mortgage indebtedness. So if we go back to that period, that was the period of no income, no asset, no problem, right? You either had to sign your name or fog a mirror. You did not need to do both to get a mortgage. There wasn't that the proper prudent underwriting that had to prove a borrower's ability to repay a mortgage. And as a result, a lot of people got extended credit that shouldn't and couldn't afford the homes. And the debt instruments back then were largely toxic. What do I mean by that? Well, they were fixed for 1, 2, or 3 years, and then they went adjustable. And they often had prepayment penalties that were 3, 4, or 5 years. So they had adjustable rate loans, nasty prepayment penalties, and a lot of these loans that they didn't even prove their ability to repay or where their down payment came from, or didn't have to have good credit. A lot of these loans, in addition to that, had negative amortization. That means that if my interest rate was 7, I could make a payment based on 3%, and the delta of the interest between what I was paying at 3 and the actual rate at 7 got added on top of the balance of the mortgage. So instead of the mortgage balance going down, the mortgage balance was going up. So no underwriting prudence, adjustable rate loans with nasty prepayment penalties, which by the way are illegal now, negative amortization, and they were adjustable rates. So when mortgage rates went up, they had payments that exploded and people couldn't make those payments, especially after the negative amortization period ended. That is very different than today. So today, this is information of all the mortgages in the country. By the way, 2/3 of all homes in the United States are owned free and clear. So roughly 66% of the homes in the United States have a mortgage against them. And of those 66% that have a mortgage, almost 80% of those loans have a mortgage rate below 4%. And of those mortgages, 90% are fixed rate loans, 10, 15, 20, 30-year fixed mortgages, not adjustable, no negative amortization, had to prove their income, had to prove their down payment, had to prove their credit. And so even though mortgage rates have gone up from, 2.75 to 7% in November at the peak, well, why wasn't there like a major housing crash? Well, because 80% of Americans had fixed rate mortgages at 4% or below. So this slide really tells me 2 things. Number one, the mortgage indebtedness that's out there is on a very safe foundation. These people prove their income. They have low mortgage rates. They don't care if rates are at 7% because I'm at 3%, right? I'm sure many of you that own homes are feeling very similarly. That's the first thing. The second thing that this tells me is a lot of these people, if they're smart, should never sell these homes. When you've got a mortgage interest rate at 3.5 and the market's at 6, that mortgage is not a liability. It's an asset, because you can rent the house out for way more in almost every situation than your payment's going to be on a 2.5%, 3%, or 3.5% mortgage. And what that means is more people are going to hold their current primary residence, convert it into an investment property, maybe move a kid into it or an elderly family member, and then they're going to buy a new home because they don't want to let go of that 3% interest rate. Just to check in with everybody here, who agrees with me that it would be hard to give up your 2%, 3%, or 3.5% interest rate? If I can get an emoji, a thumbs up, a clap, I would love to get a little bit of reaction if you feel similar to that. By the way, in the chat box, there's that little happy face, and you can click on the happy face and you can give me one of these. If you think I'm a nerd, you can just give me one of those. Bam. Yep, not giving up free money. Oh, hell no. Totally. All right, cool. I have 2.75. I'm never giving it up. Yeah, that's right. And millions of Americans across the country are feeling that same way. And I think that's going to really diminish the amount of supply that comes onto the housing market. All right, Josh, how do you know that the last housing cycle is different than the current housing cycle? Well, let's look at a couple of indicators. During the Great Recession, unemployment rate 10%, current unemployment rate 3.4%. That actually might have just gone down, and I might have missed an update, but it's right around there. Total payroll jobs, W-2 salary, these are employees. There was 130 million in the Great Recession. Today, there's 153 million. So there's 33 million more people with jobs during the current housing cycle than before. This is total jobs. This is from a different survey. It's called the Household Job Survey. And this looks at both W-2 wage earners and self-employed folks. You can see that they show there's 20 million more employed today than then. So 20 million more people have jobs. And instead of having 4 million homes for sale, there's only 970,000 homes for sale, right? Subprime loans prevalent in the Great Recession, zero, virtually none in the current market because of law. The Dodd-Frank Act basically made it illegal to do one of those loans. 5-year cumulative new home construction. Add up all the homes built over the last 5 years, 4.6 million. Over the 5 years previous to the Great Recession and the housing crash, 7.65 million. So 40% less homes built over the last 5 years, 20 million more people with jobs. Inventory on the market, 3.8 million. That's existing home inventory. The actual inventory with new homes was higher than that. Today, 970,000, 74.5% less inventory in 2023 than compared to 2000, it was probably 2008 when the peak of that inventory hit. Mortgage delinquency rate, 10.1%. Today, 2.8%. By the way, if you're late 30 days, it's a mortgage delinquency. Homes in foreclosure, 4.6%. Homes in foreclosure today, 0.6%. So this picture looks nothing like this picture. None of those things line up to tell me that we're ready for another housing crash. Okay, all coast is clear, Josh. Go put 2 houses under contract and resume investing. All right, so let's not ignore the fact that there was a slowdown in home prices last year, right? So let's make sure we understand why that happened. This is home values for 2020, 2021, 2022, starting in January, and then kind of moving throughout the course of the year to December 31st. And you can see that there's a normal seasonality to home values. Not many people want to move over Christmas and New Year's. So home values seem to type to trough in February because nobody's home hunting in January. And then we see the price of homes kind of go up throughout the year because there's more buyers entering the market. And we see kind of this similar trend each year, 2020, 2022, 2021, excuse me. Wow, 2022, massive increase in prices. And then what happened? Whoops, mortgage rates hit 6%, 7%, and we saw a reduction in prices. And we've started the year in 2023, right about this section right here. This is January 22nd, 2023, right here, just about 1% above where we were last year. So what happened here? Why did housing prices peak and come down last year? Well, that's not hard to explain. Let's look at payments. 2020, payments basically went sideways. 2021, payments went up, but they basically went sideways. 2022, house payments went from $1,650 a month on average up to $2,500 a month. Goodness gracious, that is a massive increase of $673 in 9 months. And that caused people to go, whoa, time out. I'm going to pause. I'm going to punt my home buying from 2022 to 2023. Let's just see how this all goes. But what I'll point out to you is average payments peaked in September, October, November. And with home prices moving kind of sideways from the fourth quarter of 2022 into the first quarter of 2023, we can see that home prices, or average payments, I should say, have come down from $2,500 to about $2,300 because mortgage rates have come down. So we can see that more affordability is likely to bring more of those buyers back into the market. And we can just see, we can just look at this one other way. This is a chart of 30-year fixed mortgage rates going back to, that's probably right around 2002. And we can see, again, recession, mortgage rates go down, recession, mortgage rates go down. Mortgage rates peaked November 10th, just over 7%, and since have drawn down closer to the 6% range on average. So we can see that's going to add a little more affordability, while at the same time, there's 3 components to affordability: price of the home, interest rate on the mortgage loan, and then the income that the borrower has to service that debt. So this is an interesting data point we need to be looking at. According to ADP, which is the largest payroll processing company in the world, they process 60 million payrolls. Can you imagine that? 60 million payrolls every 2 weeks. They have a tremendous amount of data. And what this recent ADP report as of January 2023 said was that that wages for W-2 employees were up on average 7.3%. And during that period of time, based on the ADP report, there were 235,000 jobs added to the economy in December, and wages were up 7.3%. But if you read the full report, it says that people who stayed at their job had an average increase of 7.3%. But switchers, those are people who changed jobs, they actually saw a 15.2% increase. So if you look at it as a national basis and you average the stayers and the switchers, the average American employee saw a 9% increase in household income. So as we kind of put together this investment thesis, what's going to happen with real estate in 2023, we have to think about how much supply versus demand is there, new construction versus household formations. We have to think about where interest rates are going to go and how that's going to affect affordability, and then how much money people are going to have to spend to service those new debts. And we tie all those things into a thesis. So I'll give you my projection after this, but let me just share this fact about the housing market and tell you why I think there's a great opportunity in the housing market right now. So you can see that there's this kind of consistent upswing let's see, kind of upswing really starts at the end of February. So let's call that, Q2 and Q3 of the year, we see this increase. Well, what is this increase? This is the average home sold price relative to the listing price. So if I listed my home for 500,000 and it sold for 505, then I sold above the list price. If I listed my house for 500 and it sold at 495, then it would be less than 100 on this index. So we can see that in 2022, or excuse me, 2020, which was the first year, the gray bar here, that houses were selling for below the asking price. Remember, this was COVID. Everybody was freaked out. And then they realized they could all work from anywhere in the world on Zoom. And we started to see the sales price of the home come up towards the asking price. This is the buyers and the sellers getting aligned. Then in 2021, boom, bidding wars galore. People were paying on average 102% of the list price. People were, $50,000 over ask price. Same kind of similar phenomenon in 22. And here we are today. Right now, nationally, homes are selling for 97.8%. I believe based on everything we're seeing, this is the golden opportunity. The first 3 months of the year where there's a little bit of softness in the market, you might still be able to get a seller to contribute towards permanently or temporarily buying down your mortgage rate. You might be able to get the price below the asking price. But I believe once we get into Q2, March, April, May, into June, we're going to see a similar type scenario where you won't be able to buy homes below the listing price. So that opportunity to me looks like it's now. All right, so here's our predictions for 2023. We think home affordability will continue to improve for the three major reasons I mentioned: inflation trending downwards, mortgage rates decreasing, incomes are increasing. So that all means greater housing affordability. Housing supply will remain low because of subdued new construction. Yes, I will definitely get you these slides. Happy to send those to you. Housing supply will remain low because of subdued new construction and higher household growth rates. Remember, for the last 7 years, more new family or household formations than there was construction. Those people got to go somewhere. And I showed you in a previous slide that not only is housing inventory at 970,000, but vacancy rates are insanely low. So where are they going to go? When I kick Xander and Aria out of the house, they either got to rent or they got to buy, and their options in today's market, if they were moving out today, are limited. And rents will remain elevated because of what I just talked about, historically low vacancy rates. So our projection for the year is we anticipate low single-digit appreciation. So I do not think we're going to see 10, 12, 20, 30% wacky appreciation of homes like we saw during the post-COVID era. But we think it'll be single-digit appreciation with a definite pickup in activity of sales. We're already seeing that, by the way. I was just talking into a realtor buddy of mine, and he said that the number of sales per week in January compared to the number of sales per week in the first 2 weeks of February have gone up 400%. From in Salt Lake County, selling about 100 homes going under contract a week to now over 400 homes going under contract. So we're already seeing that. And mortgage rates bottoming between 4.5 and 5% by the end of summer. Remember, those big inflation prints in April, May, and June of 22 are going to be replaced with the inflation numbers from April, May, and June of 23. And when that happens, inflation is going to take a massive nosedive and mortgage rates will follow. So let's see. Yes, slides. Happy to send them to you. Do me a favor, just if you don't mind, drop your email into, actually, no, we'll just send the slides and a video recording to everybody who registered. So we'll just make it easy on you. All right. Last two things here. I know we're about out of time, team. So thanks for all your interaction. It's been a pleasure to be with you tonight. I believe that you need local data to make good decisions, and virtually everything I've shown you here tonight is national data. But the variations by state are as big as the variations by neighborhood. And you can see the variations in appreciation over long term are huge. This is home values going back over to 1991. And you can see the gray states are kind of average appreciation states over 30 years. They've seen a 305% appreciation rates. The brown states are your slower appreciation states. Your green states are your states that have had massive appreciation. Look at Utah. Utah is the #1 fastest real estate appreciation rate in the entire country at almost 600% appreciation over 30 years. So because the economic vibrancy in these states and in the communities vary, you need local data to make a good decision. The best thing I could offer you is reach out to the person who invited you to this presentation tonight and ask them for a local and personal real estate report card. This gives all of the data and analytics that I look at before I buy any investment property anywhere in the country. I want to know these things, and I want to know it specific to the neighborhood and the price of the home that I'm looking for. So this was an analysis we did for a client in Salt Lake City. They were looking to buy a $1.25 million home. So I don't want to see data on how $400,000 homes have appreciated. I want to know how $1 million homes have appreciated. So we were able to show them, over 63 years, the homes in that neighborhood in that price range appreciated at 4.4% per year. Over the last 10 years, it's been almost 8%. Over the last 5 years, it's been 10%. And then we can show a cumulative appreciation forecast, how many dollars in appreciation they would earn over 5 years. We break down affordability. We go so far as to look at the amount of inventory. What are the demographics? I mentioned that first-time home buyers are 33. So, is the population old or young? How many buyers are they? Is this an active, vibrant area or not? How many renters? How many are qualified to buy? We can forecast household formations and the number of first-time home buyers based on the percentage of home ownership for your specific neighborhood. And then we can show you how many homes are going to be built based on permits relative to the number of household formations. So this is the supply, this is the demand. You can see in this neighborhood, they needed all of these boxes to fill the demand, and there's a drastic shortage in the amount of supply. We can show household income. We can show employment or unemployment rates relative to the country. And when you take all of this data together, you can come up with a pretty strong thesis. Hey, unemployment level's low, income's going up, there's a lot of first-time home buyers, and there's not enough inventory. What do we think is going to happen with value? So if you want this done for your home, your neighborhood, or a neighborhood you're interested in, reach out to the person who invited you here, and they will help you create this real estate report card. Lastly, thanks for sticking in there with me. Thanks, Jim. Appreciate you. I want to redo this survey. And again, if those that are in the real estate and mortgage world, I'd ask you to refrain. But the homeowners, the potential buyers, the potential sellers, I'd love you to redo this housing market poll to see how your thoughts are. Do you think a housing crash is imminent? Do you believe current mortgage rates are unprecedented? And lastly, do you feel worse about your ability to buy a home in 2023 because you believe that mortgage rates are going higher? I'd really like to kind of compare the before and after of those of you who are not inside the housing market to see if this has been helpful for you or a waste of 61 minutes. All right. Last but not least, for government compliance, I need to show that little disclosure there. And here's our results. All right. The results are, do you believe a housing crash is imminent? 100% say no. Do you believe the current mortgage rates are unprecedented? 94% say no. That's a drastic improvement. And do you feel worse about the housing market? 78% say no, they do not feel worse about a housing market. So that was great. I really appreciate you giving me the feedback. And those numbers are drastically better than the first housing market poll that were kind of a lot more pessimistic. So with that, team, thank you so much. I appreciate, and I would appreciate if you would reach out to the person who invited you here to this webinar. And if you got value out of it, please let them know. Thank them for inviting you. Thank them for providing the information. Ask for your real estate report card. And if I can do anything for you, you have additional questions, feel free to email me or contact me directly. Thanks, everybody. Have a wonderful evening. It was a pleasure hanging out with you. And thanks for all your activity in the chat. This was really a lot of fun for me.